Today we're going to review 3 of our favorite charts that we're sharing with clients. So let's get right into it. My name's Joe Conroy. I'm a certified financial planner with Hartford Retirement Planners. The market has definitely been in the news lately, so we're trying to help our clients make sense of it. If you do work with us and you're watching this video, 1 or 2 or maybe all 3 of these look familiar to you. So, in the words of the famous Sergeant Joe Friday, just the facts, ma'am. We're going to try to cut out some of the commentary and get into the facts. So let's start with our first chart, which comes to us from MFS Investments. So let me talk you through this first chart. It can be a little intimidating when you first look at it with all the boxes and colors. So what this chart is showing us is different asset allocation options for where you can invest your money, different asset classes, put another way. And it starts with the year 2003. So we've got the last 20 years of the market. Anything that's at the top of the chart was a better performing asset class for that year. Anything at the bottom would be one of the worst performing asset classes that year. So let's walk through an example, one that might resonate with a lot of people. You get a new job and you're signing up for your 401k, 403b, TSP, whatever it is that your company offers for retirement plans. You probably look at the different investment options and you pick one of the ones that had the best, maybe 3-5 year performance numbers, right? You don't want to pick just the 1 year because that might not be a long enough track record. You want something with a little bit more history. So let's start in 2003 and look at international. So that's the red box. If you had invested your money in an international index from 2003 to 2007, you had one of the best performing asset classes over that time frame. Well, let's say you get a job at the end of 2007, beginning of 2008. You look at the 5-year number, you put your money in international, and what happens? 2008 happens, and it was the worst performing asset class that year. But that might be the only year that you had money invested in it. It could be super frustrating. So if you give up on it early and you buy something else, rebalance that account, what happens the following year in 2009? It goes back to being one of the top 3 asset classes for 2009. So this is what makes investing when you're not diversified, which is the point of this chart, such a frustrating endeavor. You're really never going to know what the top performing asset classes are until you're looking in the rearview mirror and you're looking at what happened in the past. Unfortunately, no one has a perfectly clear crystal ball, so what we opt to do is something similar to what's in the middle of the chart. So you've got a little darker gray box, I believe, and it says diversified portfolio. Now this is just an example, but this takes equal parts of all the different asset classes that you can invest in and just mixes them up. What you'll notice is that the diversified portfolio is never all the way at the top, but it's also never all the way at the bottom. So it kind of hangs out in the middle there and should create a smoother ride for most investors. Now, the actual makeup of the diversified portfolio is something very personal, and you want to work with your financial advisor if you're not a client of ours to make sure you have the right mix for your circumstances and risk tolerance. A lot of times when we're presenting this chart to folks, people try to pick out the patterns of what's at the top. It's impossible. There is no repeatable pattern. If there was, we would be implementing that strategy right now. So the best bet for most people is create some type of appropriate diversified portfolio, and you want to hold it through most market turbulence, ups and downs. All right, switching gears to our second chart, which comes to us from JP Morgan. It is the annual returns and intra-year declines of the S&P 500. Now that's a mouthful. Let me make it a little bit more simple for you. So we're going back a little bit further. This starts in 1980. And what you see with the bars, which is what we're going to focus on first, is this is what the actual S&P 500 did during these calendar years. So we've got 43 years of different market results. And I'm going to ask you a question. It's not a trick question. What do you notice about the number of up bars versus the number of down bars? Should be obvious. We've got 32 up bars out of the 43 years that we're looking at here. So roughly 3 out of 4 years are up. Now, it isn't 3 years up, 1 year down. That would be a nice pattern that we could really use to implement investing strategies. It is relatively more random, but there's way more up bars. The second thing I want to point out about this chart are the red dots. So what is that red dot? What does it signify? Well, every year in the market, there's an intra-year low, meaning at some point the market pulls back, beginning, middle, and maybe a couple of times throughout the year. So this is from peak to trough, the very low point for that given year. Let me go back to 1980 and talk you through that example. So the gray bar shows us that the market was up 26%. So January to the end of December, up 26. But somewhere in that year, the market had a temporary setback of 17%. I can't remember, maybe it was the beginning, the middle, the end of the year, but whatever it was, there was a pullback, and if you were a patient investor, you ended up getting 26% positive that year. So what you can see here is that every year has a red dot. Every year has a low point for the market. Now, usually the years end up positive, but not always. And there's another thing that this chart begins to show us, which the next chart I'm going to go to has a little bit more detail about, but some of the best up bars or positive performance in the market over stretches of time come after a market decline. So 2008, we look at the 2000s, and then some of the ones in the 80s and 90s. You see there's very strong market performance following a market decline or a bear market. So let's get into our third chart and give you a little bit more detail about what market recoveries look like after a down market. So here's our third and final chart, which comes to us from MFS. And this goes through various bear market environments, what the peak to trough, so top to the bottom, negative performance was, and then what happened the following 1 year, 5 year, and 10 years in the market after a market drawdown of 20% or more. So I'm only going to point out a couple, but we've got the Great Depression, post-World War II recession, the Arab oil embargo. I think a lot of folks watching might remember that, where interest rates shot up and we had similar type of difficulties that we do today. Dot-com bubble, Black Monday, the market dropped 20% in one day, so on and so forth. So each one of these events has 4 bars that you can see. The red bar is the actual negative drawdown in the market. The next bar over, the bluish one, that's what the market did 1 year following the down market. And then we do the next bar over, which I guess is like a greenish sage. Comment below if you've got a better name for that color. But that is what happens 5 years after a bear market, and then 10 years after is the purple bar that you have here. One thing that you notice is that coming off of a down market is some of the best times to be an investor. A lot of people think about real estate. It's a little bit more of an easier concept to understand. If any of us could go back and buy houses in the early 2000s, right? The deals that you could get compared to where prices are today are phenomenal. We wish we could go back in time and invest our money in real estate with the much lower prices that there were back then, or even pre-COVID. You know, we don't have to go back too far, and your housing prices have gone up 20, 25% in a lot of different markets. The stock market's not that much different, but think about it this way. Instead of investing in houses or apartment buildings or things like that, you're investing in these huge multinational profitable corporations. We're talking Microsoft, Apple, JP Morgan, 3M, so on and so forth. So instead of buying houses, we're buying these big profitable companies. And what they do after a recessionary period that may include a bear market, and I can't guarantee this going forward, so I have to make a compliance comment. Past performance is no guarantee of future results, but let's talk about that past performance. 100% of the time that we've had bear markets, there's been a full recovery and achieved higher highs, okay? Being an investor is very difficult because it requires us to be patient and stick with the plan when we've got all of these news headlines and things that are trying to get in the way of what our long-term goals are. Now, if you got my Sergeant Joe Friday reference from earlier in the video, you're probably at the age where you don't have as much time to be an investor as maybe somebody in their 30s and 40s. And I understand that, but the recovery period usually is a 1 to 3 year recovery cycle for most bear markets. So while yes, you might not have the same time for a market recovery you did earlier in your life, it doesn't take as much time as most people think it does. And hopefully you're going to be with us for at least 10, 20, 30 more years and have a full retirement. So there's a very good chance that you might see several different market expansions and contractions even after entering retirement. So it's even more critical that we keep a good investment strategy and we stick with it, and we have one that's diversified and built for many different market situations that might come our way down the road. So I'm going to leave you with one bonus chart, and it doesn't have all the color and pretty pictures that the previous ones, but the data, just the facts, are super important. So the S&P 500, when we're looking at the average of the 10 worst years in the market, negative 14%. And if you had invested $10,000, what would you have a year later? On average, a positive $11,220, meaning that you've recouped your money and you've started to see that growth 1 year later, on average. 3 years later, even stronger, over 14,000. 5 years, 10 years, even stronger still. Now, I want to point out some data that might fly under the radar. If we look underneath that first row, we see the amount of positive returns for that time period referenced as a percentage. So when the S&P has one of its worst calendar years, 0% that it's positive, right? But let's look at the next column over. 70% of the time, the market is up a year after a bear market. If we stretch it to 3 years, 90% of the time, you're back into the green. And then you have 100% for 5 and 10 years. So if you plan on needing this money in retirement, before retirement, if you've got more than a 3-year time frame for how you want to have this money last longer than that, 90% of the time in the past, not guaranteeing the future, it has recovered. So the bear market really bottomed out in September, October of 2022. Here we are in November of 2023. We have seen some recovery, stalled a little bit this year, but things are trending in the right direction. We just have to do this very difficult thing of being patient and tuning out all of the noise that's out there, which is so difficult. I know it. So that's our investment thesis. These are some of the charts that our clients are finding a lot of value in. Hopefully this helps make investing a little bit more understandable and kind of make sense of what's going on out there. As always, thank you for watching.